This is a PodFast summary of the conversation between Howard Marks and We Study Billionaires, discussing market cycles and smart investing. In the conversation, the hosts discuss the concept of a sea change. Imagine you have a favorite recipe, one that you follow each time and it turns out perfect. But one day, an essential ingredient becomes unavailable, so you need to adapt the recipe, or even create a new one. That's the essence of a sea change in investing. By understanding these changes and knowing how to invest when they're happening, you can come out ahead and even thrive in spite of them. Key Idea 1. The Sea Change. A sea change is a term Howard Marks uses to describe pivotal shifts in the investment world. But before we dive deeper into this concept, we need to understand what drives these sea changes. According to Marks, they stem from the natural cycles that occur when individuals or groups get carried away by optimism. It's like a child inflating a balloon beyond its limit. What happens? It pops. This is analogous to how an overly optimistic market behaves, inflating until it can't sustain itself, and then bursting, resulting in a downturn. However, just like a balloon doesn't explode at the slightest touch, these market cycles aren't immediate or dramatic at first. They often swing gently, akin to the ebb and flow of the sea tides. But a sea change, as Marx puts it, is a different beast. A sea change is like constructing a dam across a river. Once the dam is built, the river's flow is permanently altered. Similarly, a sea change in the investing world is a significant shift in perspective that permanently alters the way investors think and operate. In understanding this, we can learn to spot the difference between regular market shifts and sea changes and behave accordingly in each part of the cycle. Key Idea 2. New changes are coming. Let's focus now on a compelling forecast Howard Marks makes about the impending third sea change. The centerpiece of this transformation, he suggests, is the shift away from ultra-low interest rates. It's important to understand that interest rates act like a thermostat in the financial house. They regulate borrowing costs, which in turn influences the cost of buying a house, starting a business, or funding government projects. The lower the interest rate, the cheaper it is to borrow money, and this has a profound effect on the economy. Imagine a long summer day where you're making your favorite ice cream. The recipe is perfect because the conditions, like the temperature, ingredients, and freezer settings, are all just right. Now imagine if winter arrives. The same recipe might not yield the same result because the surrounding environment has changed. Marx suggests that we're transitioning from the metaphorical summer, characterized by ultra-low interest rates, to winter. The consequences of this shift will likely be as impactful as a change of seasons. Marx's foresight highlights the importance of adapting to new realities in the investment landscape. As the third sea change reshapes the financial world, savvy investors will be those who can revise their recipes to match the shifting seasons. Key Idea 3. The Rise of AI. Now, let's delve into Marx's vision of the future where AI and machine learning play a bigger role in investing. To paint a clearer picture, think of AI as a lightning-fast calculator that's capable of solving complex math problems in a blink of an eye, making our manual methods seem like chiseling numbers on stone tablets in comparison. AI, with its machine learning capabilities, excels at number-crunching tasks, the ones that involve statistical analysis, pattern recognition, and other processes that can make a human brain ache. With advancements in technology, AI systems are becoming more sophisticated and efficient. They're transforming the way investors analyze markets and make decisions. Just like the invention of the calculator revolutionized math, AI is reshaping the investment landscape, making it easier to analyze vast amounts of data and identify profitable opportunities. However, there's an important caveat that Marx stresses. While AI is indeed a powerful tool, it can't replace human intuition and understanding of subjective matters. It's like expecting your calculator to understand and appreciate the nuances of the story in your English homework, or expecting it to predict what will happen next in the novel you're reading. Similarly, AI may be able to analyze data and identify patterns efficiently, but it's not equipped to interpret subjective elements like human sentiment, or to foresee unexpected future events. For example, it can't assess a sudden shift in consumer behavior triggered by a cultural phenomenon. According to Howard Marks, the future of investing is one where AI tools and human intuition work in concert. To benefit fully from the rise of AI, we should pay attention to what it can and can't do well, and work alongside it instead of trying to replace the human element completely. Key Idea 4. patience, prudence, and humility. Let's explore the essence of Howard Marks's investing philosophy, a recipe that he has cooked up through years of experience in the financial markets. The key ingredients, as he describes them, are patience, prudence, and intellectual humility. Consider the first ingredient, patience. Imagine investing like embarking on a long and winding journey, perhaps a cross-country road trip. No matter how much you push the pedal to the metal, it's not going to magically teleport you to your destination. Rushing might even lead to missed turns, detours, or worse, accidents. Marks emphasizes a similar approach when it comes to investing. It's not about making a quick buck overnight, but nurturing your investments over a significant period. Like planting a seed and waiting for it to sprout, grow, and finally bear fruit. Successful investing requires patience. Next on the list is prudence. When on your long journey, you wouldn't drive recklessly, would you? Instead, you'd stay vigilant, follow the traffic rules, and carefully navigate through potential hazards. Similarly, investing demands prudence, like a tightrope walker maintaining balance. The final ingredient is intellectual humility. Despite all the GPS technology at your disposal, there could be times when you take a wrong turn or find yourself lost. At such times, admitting that you don't know the best route is crucial. This allows you to seek help, reassess your path, and get back on track. In investing, intellectual humility is about understanding and accepting that we can't predict the market with absolute certainty and that our decisions may be wrong. It's about being open to learning and, if necessary, adjusting our course. Key idea 5. Controlling the economy. When discussing attempts by governments to control the economy, Marks expresses a healthy skepticism. Picture this scenario. You're planning a sunny outdoor event. You've arranged everything, right from the decorations to the food. However, despite all your best efforts and detailed planning, you cannot control if it will rain on the day of your event. Marks views government attempts to control the economy in a similar light. Despite their arsenal of fiscal and monetary tools, from tax policies to interest rates, their control is never absolute. The economy, like the weather, is influenced by a multitude of factors. Some are predictable, others not so much. There are elements beyond control, like international trade or societal changes, which can sway the economy in unforeseen ways. Now let's journey eastward and consider Marx's thoughts on China. He holds a nuanced view, one that recognizes both the awe-inspiring progress and the lurking uncertainties. Imagine a flower blossoming amidst a thorny bush. The flower is beautiful, representing China's remarkable economic growth and progress over the past few decades. However, surrounding this vibrant flower are thorns, the geopolitical tensions and uncertainties that China faces. These thorns represent potential risks and challenges, including issues around human rights, territorial disputes, and questions about regulatory changes. Like a gardener tending to the blossoming flower while being cautious of the thorns, investors interested in China must appreciate the economic miracle while remaining aware of these geopolitical complexities. In both these instances, Marx brings forth the lesson of humility and cautious optimism. Whether it's governments trying to steer economies or investors looking at emerging markets like China, acknowledging the uncertainties is as important as recognizing the opportunities and achievements. Key idea 6. The unquantifiable. Howard Marks believes that, through superior understanding of probability distribution and creativity, we can handle the unquantifiable. To grasp the first concept, imagine the game of poker. In poker, each player is dealt a hand, a set of cards. But the game's outcome isn't just about who has the highest cards. It's about understanding the odds of winning based on the cards you and others hold. This ability to analyze and interpret the probability of various outcomes is similar to understanding probability distribution in investing. This could mean evaluating the likelihood of various investment outcomes based on existing data, market conditions, and potential future scenarios. The second concept is the ability to deal creatively with the unquantifiable. Back to our poker analogy, think about how a successful player does more than just calculate odds. They also play the player, reading opponents' behavior, bluffing, and making strategic decisions based on these observations. This involves dealing with aspects that can't be measured or quantified, but significantly impact the game's outcome. In investing, not everything can be neatly measured or predicted. Factors such as market sentiment, consumer behavior, political developments, or technological innovations often don't fit neatly into statistical models, yet they significantly influence markets. This is where creativity comes in. Marx emphasizes these two aspects: a solid grasp of probability distribution and a knack for dealing creatively with the unquantifiable. Together, they equip an investor to better navigate the unpredictable waters of the financial markets, much like a skilled poker player maneuvering through a high-stakes game. Thank you for listening to this PodFast summary between Howard Marks and We Study Billionaires. If you enjoyed the content, please like and subscribe. See you next time.